Hi class. Tonight we're going to talk about Chapter 1, Managerial Accounting Concepts and Principles. The learning objectives include conceptual, which is we want to talk about the rules and ethics of managerial accounting, the accounting concepts in classifying costs, manufacturing activities and the flow of manufacturing costs, the trends in managerial accounting. Analytical, we want to look at the raw materials inventory management using the inventory turnover and the days sales in raw materials inventory. Procedural, we want to create an income statement and a balance sheet for a manufacturer. Also, we want to have a cost of goods manufactured and explain its purpose and how it links to financial statements. Learning Objective C1, the roles and ethics of managerial accounting. So, managerial accounting provides both financial and non-financial information to a company's managers. So, managers might be people that work in a certain division, the heads of marketing, IT, human resources, maybe the CEO or the CFO. And so now we'll talk about managerial accounting, also called management accounting, and we'll compare and contrast it with financial accounting. First of all, the purpose of managerial accounting is twofold. One thing is the planning. So with planning, we might consider a new factory, or maybe new products, or expanding into new markets. The other thing is control. We want to look at our costs, if they're too high. Our services, are they making us money? And are our customers happy? So in essence, planning is how we set goals and we make plans so that we can fulfill these goals. Control is looking at everything and monitoring it on what's going on in the company and with the activities and the employees. So the nature of managerial accounting. Okay, so first I'm going to outline financial accounting and then managerial. So when we think of financial accounting, a class that you should have already taken, we think of, with these attributes here, we think of the users. With financial accounting, it's usually or mostly external users, which could be investors, creditors, other people outside of the company. The purpose? Well, the stakeholders in a company, in particular, may be creditors, investors, stockholders, shareholders, would need this information. Flexibility with financial accounting, they do have to conform to GAAP, especially if they are publicly traded. If they're a private company, such as Trader Joe's, then they might not need to comply with GAAP. With timeliness, basically after a company creates their for financial statements, then when they're audited, then things can be looked at, things can be evaluated. Again, financial accounting is based on the past, what already has happened. And the focus with financial accounting is on the entire company, not on any particular department per se, but the whole company in its entirety. And most of this information is, if you're looking at their monetary information, how good they're doing on the stock market. Are they making profits? Are they doing well? Or do they have some issues? On the other hand, managerial accounting has to do with the inside users, the people that work at the company. So unless you work at a company, you wouldn't know. You wouldn't know what was going on with their budgets or with what their managerial accounting, what was happening. So the managers that work there have this information at their fingertips, right? They can look at their budgets, they can make predictions, and so forth. Managerial accounting does not really have to conform to GAAP because it's just reports and it's only internal. Even without an audit, you can look at the books of the management's files and know what's going on. So with managerial accounting, you can look at how it's doing now, and you can make predictions on how you think it might be doing based on reports and analysis, such as budgets, for example, to see what might happen based on past performance. So the focus is that you want to look at the projects, the different company divisions, and the different processes. Now there is some monetary, but there's also a lot of non-monetary things that go on with managerial accounting. Whether it's managerial or financial accounting, we always have this issue of fraud. There's still going to be fraud no matter what we do, no matter where we work, no matter who we are. Unfortunately, that's just something we can't get away with. So they did a study, the Association of Certified Fraud Examiners, ACFE. On average, about 5% of U.S. businesses have losses in regards to its annual revenue due to fraud. So what they try to do is they set up an internal control system so that managers can better regulate and maybe minimize fraud. Okay, so the internal control system that managers would do would be 1, ensure reliable accounting, 2, protect assets, 3, uphold company policies, and 4, promote efficient operations. So basically, we can go into more detail, but that's what they need to be concerned with. The Institute of Management of Accountants requires that management accountants be competent, maintain confidentiality, act with integrity, and communicate information in the way that they should. So the IMA, the Institute of Management Accountants, is a professional organization, or association I should say, that will help them be on their toes. So with the career paths, if any of you might be interested, there's a few here. Managerial accounting information is used in many careers. So you could be part of the marketing staff. They need sales and cost data to decide which products to advertise or promote. Management needs Salesforce to look at the company's performance. Entrepreneurs need to look at their budgets as well as their financial statements. And even non-business majors, they might want to use this information in their careers so they can get ahead of the game. So if you look at your book, Exhibit 1.4, it tells you the annual salary. So for top level managers, that's pretty good. If you want to become a CFO, you can make maybe $290,000 a year. Or if you just want to be maybe a division controller, you might make $130,000 a year. Or even if you want to have a mid or entry level type of job, for example, a financial analyst, $85,000 a year. That's pretty good, right? So that's something that you might want to think about. The next part of this, we'll talk about the different accounting concepts that we use to classify costs. So we have two different types of costs broken out here. One is direct costs. The easy way to remember that is costs that are traceable to a cost object. Indirect costs you cannot trace it. So, for example, if we're looking at a bicycle that maybe a company's selling, direct costs would be tires, seats, handlebars, cables, maybe the wages you're paying the manufacturer who's making the bikes, frames, chains, brakes, pedals, things like that. You can touch them, you can feel them, you know what they are. Those are direct costs. On the other hand, things that you cannot quite put your hands on, indirect costs. So you don't know where it is or how to find it. That would be factory accounting, factory rent, factory manager salary, the light, the heat, the internet, the utilities, the insurance, the equipment, the factory equipment depreciation. These things are indirect. You can't easily trace them. So let's talk about direct materials in more detail. Direct materials costs are the expenditures for direct materials that are separately and readily traced through the manufacturing process to finished goods. Again, the examples would be the tires, the seats, the frame, the pedals, the brakes, and the cables. You can directly determine the cost of these items. Also, you can directly determine the labor. So direct labor would be the wages and salaries for direct labor that can be effectively traced through the manufacturing process all the way to finished goods. So the example is the wages paid to a bike assembly worker. Factory overhead is another one. So factory overhead is made up of all manufacturing costs that are not directly or not direct materials or direct labor and cannot be cost effectively traced to finished goods. So examples would be indirect labor, maintenance workers, indirect material, screws, nuts, staples, maybe glue. Indirect other costs might be utility costs. So just be really careful when you're doing your homework. And the next one is another way to look at these costs. So we have two things here. We have we can classify products into prime and conversion costs. Prime costs includes both direct material and direct labor. Conversion costs incurred in converting raw materials to finished goods, that's what that is, includes both direct labor and factory overhead costs. Notice that direct labor costs are considered both prime and conversion costs. So with manufacturing costs, we have we use acronyms a lot. Direct labor, direct materials, factory overhead. DL, DM, and FO. And that goes into our product. So product costs are those production costs necessary to create a product and consists of direct materials, direct labor, and factory overhead. Period costs, on the other hand, are non-production costs. They are associated with activities linked to a time period and not to the completed products. So, period costs might be selling expenses, which are costs to obtain orders and to deliver finished goods to consumers. Period costs also have to do with general and administrative expenses. These are costs of staff, support, and administrative type of functions. So looking at this slide, we can see here that product costs are those production costs necessary to create a product, and they consist of direct materials, direct labor, and factory overhead. Overhead refers to production costs other than direct materials and direct labor. Product costs are added to inventory or capitalized during completion of products. They become cost of goods sold when the products are sold. Period costs are non-production costs. They are associated with activities linked to a time period and not to completed products. Period costs are expense in the period when incurred and reported on the income statement as either selling expenses or as general and administrative expenses. So, examples of selling expenses would be advertising, delivery costs, salesperson salaries, commission, travel costs. Examples of general and administrative expenses are office accounting costs, office employee wages, rent, depreciation on office equipment, office manager salaries. Just remember, for a manufacturer, period costs are also called non-manufacturing costs. So, reporting product and period costs in the financial statements. So here's a nice little graph. Period costs go directly to the current income statement as expenses. They are not reported as assets. Remember, expenses, costs, those are all on your income statement. Product costs, on the other hand, are first assigned to inventory. Their final treatment depends on when inventory is sold. Product costs assigned to inventory that is sold in 2021 are reported on the 2021 income statement as cost of goods sold. Product costs assigned to unsold inventory are reported on the 2021 balance sheet. If this inventory is sold in 2022, product costs assigned to it are reported as a cost of goods sold in the 2022 income statement. So we'll first talk about cost concepts for a service company. Remember that a service company does not have inventory. The cost concepts also apply to a service organization. As I just said, service companies can classify cost as direct materials, DM, direct labor, DL, overhead, OH, selling or general administrative costs. Classification as a product versus period cost is not relevant to service companies because services are not inventoried, just like what I said. Instead, costs incurred by a service firm are expensed in the reporting period when incurred. Okay, example. For Southwest Airlines, the cost object is a flight. The airline's cost of beverages for passengers is a direct cost. The cost of ground crew's wages is an indirect cost. So now we're going to prepare an income statement and a balance sheet for a manufacturer. So now we're going to look at reporting inventory on the balance sheet. So manufacturers, they carry several unique assets and usually have 3 inventories instead of the single inventory that merchandisers carry. So manufacturers have raw materials, work in process, and finished goods inventory. So raw materials inventory is the cost of materials a firm acquires to use in making products. Companies use raw materials in 2 ways, directly and indirectly. Raw materials that are cost effectively traced to a product are called direct materials. They are included in raw materials inventory. The WIP, which we call work in process inventory, also called goods in process inventory, consists of costs of direct materials, direct labor, and overhead for partially completed products. So remember, WIP is partially completed products. Finished goods means they're ready to sell it. Finished goods inventory consists of direct materials, direct labor, and overhead of completed products ready for sale. So when we're looking at a balance sheet for manufacturers, merchandisers, and services, it's a little bit different. It depends on what entity we're talking about. So when we look at the service company, we notice that there's really, there's no inventory, so it's very straightforward with a service company, like a service. So we just have our assets, and we have, our total assets, and that's about it. With a merchandising and a manufacturing company, it gets a little bit more complex. The primary difference in the balance sheet of a merchandiser and a manufacturer is inventory. Merchandisers have one inventory called merchandise inventory. Manufacturers have three major categories of inventory: raw materials, work in process, and finished goods. The current asset section of the balance sheet will look different, as I said earlier. A merchandiser will report only merchandise inventory rather than the three types of inventory reported by a manufacturer. A service company's balance sheet does not have any inventory. So looking at this, if a company is actually manufacturing, creating their own product, making their own product, then they will have a more complex type of balance sheet, as shown in this slide. So reporting costs and the income statement. So if you look at Exhibit 1.11 in your book and also 1.12, you would see this graph. So the main difference between a manufacturer and a merchandiser is the content of cost of goods sold. Merchandisers add cost of goods purchased to the beginning merchandise inventory and then subtract ending merchandise inventory to compute the cost of goods sold. Manufacturers add the cost of goods manufacturing to the beginning finished goods inventory and then subtract ending finished goods inventory to compute the cost of goods sold. The main differences or key differences on the income statement: 1. Merchandisers have merchandise inventory while manufacturers have finished goods inventory. 2. Merchandisers have cost of merchandise purchased while manufacturers have cost of goods manufactured, direct materials, direct labor, and factory overhead. Since a service company does not make or buy inventory to sell, it does not report the cost of goods sold. Learning Objective C3. Explain manufacturing activities and the flow of manufacturing costs. So now it gets a little bit more complex. So let's see what we can do. So this slide shows the flow of manufacturing activities and their cost flows. Looking across the top row, the activities flow consists of materials activity followed by production activity followed by sales activity. The boxes below those activities show the cost of each activity, and how costs flow across 3 activities. Materials activity. Manufacturers usually start a period with beginning raw materials inventory left over from the prior period, then buys more raw materials in the current period. Adding these purchases to beginning inventory gives total raw materials available for use in production. These raw materials are then either used in production in the current period or remain in raw materials inventory at the end of the period for use in future periods. Production activity. Manufacturers usually start a period with beginning work in process, which equal the cost of partially completed products from prior periods. Production then adds the cost of direct materials, direct labor, and factory overhead for the current period. Production activity results in products that are either finished or unfinished at the end of the period. Total cost of direct materials, direct labor, and factory overhead for finished products makes up the cost of goods manufactured. That amount is carried over to the current period income statement in the computation of cost of goods sold. Total cost of direct materials, direct labor, and factory overhead for unfinished products makes up ending work in process inventory. That amount is carried over to the current period balance sheet. Sales activity. Sales activity. This is the cost of the beginning inventory of finished goods plus the cost of newly completed units, goods manufactured, equals the total finished goods available for sale in the current period. The cost of finished products sold is reported on the income statement as cost of goods sold. The cost of any finished products not sold is reported as a current asset, finished goods inventory, on the balance sheet. Next, we'll talk about Learning Objective P2, prepare a schedule of cost of goods manufactured and explain its purpose and links to financial statements. So, manufacturers of a manufacturing firm analyze product costs. So, with the schedule of costs of goods manufactured, it basically summarizes the types and amounts of costs incurred in a company's manufacturing process. So, if you take a look at this formula, it's very helpful. Direct materials used plus direct labor plus factory overhead equals total manufacturing costs plus beginning work in process minus ending work in process equals cost of goods manufactured. So in a nutshell, these managers can make better decisions about materials, labor, and overhead to reduce the cost of goods manufactured and improve income. Manufacturing activities are described in a report here called the Schedule of Cost of Goods Manufactured, or a manufacturing statement. Sometimes we call it a cost of goods manufactured. The Schedule of Cost of Goods Manufactured lists the types and amounts of costs incurred in manufacturing. So, we want to look at the manufacturing, an actual snippet shot of Rocky Mountain Bikes. The schedule of cost of goods manufactured for year ended December 31st. So, there's 4 parts: direct materials, direct labor, factory overhead, and the computation of cost of goods manufactured. So for number 1, to compute the direct materials used, we add the beginning raw materials inventory of 8,000 to the purchases of 86,500 to get 94,500 of raw materials available for use. A year-end count of inventory shows 9,000 of ending raw materials inventory. If 94,500 of materials were available for use and 9,000 of materials remain in inventory, then 85,500 of direct materials were used in the period. Step 2, compute the direct labor used. Total direct labor costs are 60,000 for the period. This includes wages, payroll, employee benefits, and total factory overhead would be a total of 30,000 for that. 4, compute the cost of goods manufactured. So if you add up the 85,500, the 60,000, and 30,000, you come out with 175,500. So we take that and we add it to 2,500 beginning work in process to get the total work in process of 178,000, and we subtract 7,500 of the ending work in process to get the cost of goods manufactured of 170,500. So here's just a basic way to look at this. So management uses the schedule of cost of goods manufactured to plan and control manufacturing activities, to provide timely information for business decisions. So they might prepare this weekly or daily if they want, or maybe at least monthly. Estimating cost per unit. Managers use the schedule of cost of goods manufactured to estimate per unit cost. For example, if Rocky Mountain Bikes made 1,000 bikes during the year, the average manufacturing cost per unit would be 170.50. So we just take 170,500 divided by 1,000 to get that answer. So looking at Exhibit 1.15, manufacturing cost flows across accounting reports. So we have Rocky Mountain Bikes, and then this information flows into the income statement, and then the balance sheet. So cost information is used in financial statements. Exhibit 1.15 would shows how a product costs affect financial statements. Direct materials, direct labor, and overhead costs are in the schedule of cost of goods manufactured. The cost of goods manufactured from that schedule is used to compute the cost of goods sold on the income statement. The ending work in process inventory is carried from the schedule to the balance sheet, and both the balance sheet and the income statement include the finished goods. Next objective, C4. Describe the trends in managerial accounting. So, the trends in managerial accounting, there are basically tools and techniques of managerial accounting, and they change over time and depending on the business environment. So this slide will depict some of these changes. So digital manufacturing combines machines, computers, and human control to manufacture products. Humans then use data analytics and data visualizations to plan and control operations. The growth of digital manufacturing means employers seek employees with data analytics and visualization techniques. Data analytics is a process of analyzing data to identify meaningful relations and trends. Data visualization is a graphical representation of data to help people understand their meaning. Customer orientation. Managers and employees must understand the changing needs and wants of customers and align management and operations accordingly. The global economy, our global economy expands competitive boundaries and provides customers more choices. With e-commerce, people are increasingly interconnected via smartphones, text, meaning, messagings, and other electronic applications. When we think of a service economy, businesses will provide services such as healthcare, telecommunications, and this is an ever-growing part of our economy. Lean practices would some companies have adopted a lean business model, which means they want to eliminate waste while saving the customer and providing a positive return to the firm. The value chain is basically a series of activities that add to a firm's products or services. Specifically, lean principles would be, like I said, adopting lean practices so that sometimes things have to be realigned, but managerial accounting has an important role in providing accurate cost and performance information. So a lean business model, like I said, would be eliminate waste and satisfy the consumer, as well as give the company a positive return on their money. It is paired with continuous improvement. So continuous improvement is, it rejects the notion of good enough, and yet it challenges employees and managers to continually improve their daily operations. So this information, it has created practices such as TQM, Total Quality Management, and also JIT, Just-in-Time Manufacturing. And so this is what we're talking about here. TQM, or Total Quality Management, it focuses on the quality of improvement to a business. Again, managers and employees seek to uncover waste in business activities, including activities such as payroll and disbursements. With JIT, and I believe Amazon uses this JIT method, just-in-time manufacturing is a system that acquires inventory and produces only after they receive an order. So it's a demand pool type of system. And then it delivers the customer requirements on time. So the order is taken, and then the company produces the product and then delivers it. And it happens very quick. This means that the processes must be aligned to eliminate delays and any inefficiencies. Companies must have really good communication with their different suppliers in order to make it happen. On the downside, JIT is more susceptible to disruption than traditional systems. An example, General Motors plants were temporarily shut down due to a strike. at a supplier which supplied components just in time to the assembly division. So you just want to be careful, what company it is and if they have a shutdown and things like that. The value chain is basically when, you acquire the materials. For example, if you're making cookies, if you're a company that makes cookies, you acquire the materials, you bake it, you sell it, and then you deliver it. The value chain refers to the series of activities that add value to a company's products or services. This slide illustrates a possible value chain for a retail company. Companies can use lean practices across the value chain to increase efficiency and profits. CSR, corporate social responsibility. So in addition to maximizing shareholder value, corporations must consider the demands of other stakeholders, including employees, suppliers, and society in general. CSR, corporate social responsibility, is a concept that goes beyond following the law. Triple bottom line, that focuses on 3 measures: financial profits, social, people, and environmental, the planet. Adopting a triple bottom line impacts how businesses report. In response to a growing trend of such reporting, the Sustainability Accounting Standards Board was established to develop reporting standards for businesses' sustainability activities. Some of the business sectors for which the SASB has developed reporting standards include healthcare, non-renewable resources, renewable resources, and alternative energy. So the last part of this slide is the appendix, and we want to look at A1, assess raw materials inventory management using raw materials inventory and days sales in raw materials inventory. So here's the formula. A manager can assess how effectively a company manages its raw materials inventory by computing the raw materials inventory turnover ratio as shown in this slide. This ratio reveals how many times a company turns over or uses its raw materials inventory during a period. Generally, a high ratio of raw materials inventory turnover is perfect, as long as raw materials inventory levels are adequate to meet demand. The days sales in raw materials inventory. So if a company wants to further assess raw materials inventory, a manager can measure the adequacy of raw materials inventory to meet production demand. Days sales in raw materials inventory reveals how much raw material inventory is available in terms of the number of days sales. It is a measure of how long it takes raw materials to be used in production. So now we have concluded this chapter, and please review it anytime that you